This is, I think, the best financial conference. I guess it's really a festival. And I'm excited to do a presentation for you. I've got a lot of slides to get through, but I want to cover really how to think about the next 12 months and think about some of the most important themes driving stocks.
What if the next bull run isn't about hype, but survival? At the Future Proof Conference, Tom Lee dropped a financial truth bomb that had even the skeptics taking notes. He claims we're still in a bull market, one powered by U.S. dominance, AI innovation, and the most resilient economy the modern world has ever seen. Lee walked the crowd through 6 black swan events, pandemics, wars, inflation spikes, that should have destroyed the stock market. Yet it didn't. Instead, it grew stronger. His message: the chaos wasn't a warning, it was a reset. And here's the kicker. With the Fed turning dovish and AI spending projected to hit $1.3 trillion, Lee says this could be the start of a supercycle few are ready for. But what if he's wrong? Is this the calm before another storm? Drop your thoughts below. Hit like, share with your investing circle, and subscribe for more market-shaking insights. Now, let's listen carefully to Tom Lee break down his market outlook.
Okay, so here's the rough outline. Foremost, I want to tell you I think we're still in a bull market, and I think it is about U.S. leadership versus the rest of the world. I think it's going to be clear as I walk you through the reasons for that. And the first place to start is why I think the investment outlook is better now than it was at the start of the year. So the S&P's up 10% year to date. You can see that huge dip that started in February, was a waterfall decline in April. I think a lot of people panicked and unfortunately sold at the bottom, but we had advised folks that when you see waterfall declines, as long as you don't have a recession, markets will stage a reciprocal recovery, which is in fact what happened. So think of that decline, which in a way was a bear market because it reset positioning, and now we're in a new bull market, but that was actually a very predictable recovery. And so if you ask me where I think we are by the end of the year, I do think it's a strong fourth quarter. So I think the S&P gets us to 68, 6,900, possibly higher. Mark Newton does think, again, similarly, that we're going to have a big fourth quarter. And there's a couple of reasons for that. One, corporate profits are strong. Household balance sheets are still strong. We've got a lot of AI visibility. Something to think about, many people don't, is the financial sector is about to have some pretty big productivity gains coming the next 3 to 5 years. And I'm going to cover that in this presentation. And the Fed is going to cut rates. Okay. So let's start with the ISM. The ISM is still below 50. It's at 48.7. If you're not familiar with it, it is the most widely used measure of manufacturing confidence. And it's 31 months now below 50. That is the longest stretch in the history of the index itself. And as we point out here, you've never been late cycle in the stock market when the ISM is below 50. In fact, you've always been mid-cycle, early cycle. So it's actually a very bullish sign that the ISM is still below 50. And in terms of households, I think the biggest reason to be optimistic on households is that there's still a lot of pent-up demand. In the last 10 years, we've actually created 15 million household formations, meaning the number of people that need housing units, and yet we've only built 13.5 million homes. So there is a shortage of housing, and that is a contrast to 2008 when we had 10 million household formations and 17 million homes built. So instead of an excess of housing, we have a shortage. That's future demand. The Fed is more dovish this year as well, and I think it's going to play into September. As you know, a lot of people are warning you about this month, saying stocks could decline because that's the seasonal pattern. But we think stocks will do well this month. And the reason for that is the Fed's been on hold, and for the first time this year, they're going to cut. In the last 50 years, that's only happened twice, 1998 in September 2024. And as this chart shows, in September 1998, the S&P was up 6%, and in 2024, we were up 2%. So it really contrasts with the seasonal pattern, and that's why I think we're going to do well this month. And in terms of cuts, I don't really know. I'm not a Fed watcher, but I'll tell you the bond market thinks there's 3 cuts this year. That's 1 more cut than the Fed has guided to. And next year, 2.5 cuts. That's a lot of easing that's coming. And I think one of the places you'll see it is in mortgage rates. The spread between mortgages and the 10-year yield is 2.43%. And since 1970, that spread is 1.7%. So mortgage rates will follow the 10-year, which may or may not go down, but then mortgage rates itself could drop 70 basis points. So I think you could see a mortgage rate in the 5.5% range next year, which is a pretty big improvement in mortgage cost. Okay, now here's a third point that's really important, and I think you have to start to sit back and think about this, which is the stock market has had 6 stress tests in the last 5 years. Okay, that's unusual. These are what I would call black swan events. You normally expect these to happen every 10 years, but we had 6 of them in 5 years. The first was the COVID shutdown. And then in 2021, after the economy was shut down, we had the bullwhip supply chain effect. You guys remember that. Suddenly factories turned on. There was a lot of confusion, a lot of ordering, a lot of shortages. Nobody really knew if things were short or demand was too high. Then we had a massive inflation cycle in 2022. And then the Fed followed that with the fastest Fed hikes in history, which caused a heart attack for the economy. And then in April of this year, we had the tariff global disruptions, which was the same as the Cuban Missile Crisis. We had the entire world watching for a single moment, and it slowed everything, and it caused a stock market crash. And then in June of this year, the US bombed Iraq's nuclear facilities, which, if you take any of these 6 events, and before any of them happened, if we said, this will happen in the next 12 months, almost all of us would have agreed each of these would have caused a recession and a bear market. But instead, the stock market survived, and this is the PE, the S&P. You can see the equal weight of the market, PE, is now 17 times. Now, some of you might say that's expensive, okay? But I disagree, because the PE, the S&P, was 18 times before any of these black swans happened. So the market is cheaper today after 6 black swan events. But here's the point I'd make. You had 6 black swan events that should have wiped out the stock market, should have wiped out profits, caused a recession, but the economy survived and the stock market survived. I would argue the PE of the market should be going up. And that gets us to the next point, which is I think there are 2 reasons to expect US growth to outperform expectations. The first is that AI is still in the early stages. I'm just pulling up numbers. These are estimates for IT spending around AI, but IDC just published their most recent report, and they are forecasting $1.3 trillion of spending by 2029. I mean, that's a huge number, okay? And look at the level of growth compared to where it is in 2024. That, of course, is a huge driver of spending. And yet the stock that's probably the most important and a beneficiary of that is NVIDIA. And you can see here it trades at 26 times earnings. Now, some of you might look at that chart and say, wow, it's 26 times. This is expensive. Now, keep in mind, number one, this is the scarcest company in the world today. They sell a product that every AI company that's going to spend $1.3 trillion a year needs. There really isn't going to be a $1 trillion LLM without using NVIDIA. And yet it trades at 26 times earnings. By the way, Costco trades at 49 times earnings, and Walmart trades at 39 times. So in a way, NVIDIA would have a higher multiple if they sold membership cards or rolled back prices to $9.99. But you get the point. If NVIDIA traded at Costco's multiple, the stock would be over 300. I think Costco is a lot less scarce than NVIDIA. So if you ask me, if NVIDIA is cheap, the AI trade is still massively undervalued. And there's a lot of productivity. Google, this is a CNBC story. Google's eliminated 35% of managers overseeing small teams. That's productivity. Now, there's a lot of people that say that this is an AI bubble. In fact, at Fundstrat, that's something we hear a lot because we hear from our clients. We have roughly 10,000 RIA and family office clients, and we hear from them a lot. Not everyone's bullish on AI. But here's the reason to be bullish on AI. The world has a structural shortage of labor. The blue line is the prime age workforce globally, and as you can see, the growth rate is slowing, okay? But the gray line is the total world population, which is growing faster than the prime age workforce. So as that blue line shows, we have a structural shortage of labor, which is the first time since 1973. So think about this. Starting in 2018, the world actually had a shortage of prime age workers. But for 2 generations, so many of us who started covering stocks in 1973, and I started covering stocks in 1973 when I was young. I'm just kidding. But for 50 years, people who invested never had to think about labor shortage. But actually, that's changed. And how does that change how you should invest? Well, I have a chart going back to 1947. And in the United States, because we have a lot of data here, there have been 2 other times where the US had structural labor shortage. 1948 to 67 and 1991 to 99. And in the gray box, I highlighted that. Whenever there's been labor shortage in America, technology spend goes parabolic. It makes a lot of sense. What it's saying is, if you don't have enough workers, then companies have to find non-human workers. Well, we're entering the 3rd phase, and that's why folks are calling this a super cycle for AI. And the bottom chart here is technology stocks. Above is that labor shortage for the US. You can see tech stocks have gone parabolic every time the US has labor shortage. So this is the 3rd cycle for labor shortage, and we think tech will at least become 50% of the S&P. Now, I want you to say, or think about something. Someone will say, oh, well, if there's labor shortage, then all these other countries benefit. That's not true. When the world had surplus labor, then the companies with cheap labor benefited. China, Asia, India, Africa. But if there's labor shortage, you still might want to find cheap labor, but only India and Africa have supply. You're actually going to try to find non-human labor, and the biggest supplier of that is the United States with AI and robots. You know, there's of course Japan, China, and Germany, but as this chart shows, all of the best tech companies and the biggest, you can see by the size of the circles, are basically US businesses. So in the next 10 years, the choice people will have to make is the next largest supplier of robots and tech is China. But is the world going to prefer to buy these from the United States or from China? And in my opinion, they're going to choose the US because that's really been the case. You know, of the 25 largest stocks in the world, only 4 are not from America. But everything else is really the US. So if you ask me, when it comes to AI, and I know there's a race with China and they've got good AI, I still think the winner is the United States. And then that gets me to the second driver, of the US, which is blockchain. Wall Street is finally embracing blockchain, and not because they're becoming believers in crypto, but they believe that this is a way to improve the cost and productivity of their business. Okay, now this is going to take a little time to explain because I don't think people are talking about this, but let me explain to you why. If our view is correct on blockchain, Wall Street stocks like Goldman Sachs and JP Morgan are going to become a lot more profitable. Their margins are going to go up. They're going to become a lot less cyclical, and their PEs will probably look more like tech stocks. So I have to go all the way back to 1971, because in 1971, the dollar became synthetic. Now, you may not know what I'm talking about, but in 1971, the dollar was no longer convertible into gold, which means the dollar became a synthetic instrument because you could only exchange it for $1. Now, think about what that means. In 1971, a lot of folks got scared and they said, well, I want to buy gold instead. And actually, that was a great investment. But if everyone bought gold, the US economy would have collapsed, right? Because the dollar represented nothing but itself. So you had to create a system where people would believe the dollar was useful, and that was what Wall Street did. They created all these financial products because the dollar became synthetic. Money market funds in 1971, currency futures in 72, debit cards in 78, mortgage-backed securities, currency swaps, interest rate swaps, S&P futures, zero coupon bonds. I mean, a lot of these you guys all remember, exchange traded funds. If Wall Street didn't do that, another currency would have become dominant. But that's not what happened, right? The dollar today is 80% of all financial transaction quoted pairs. So when we went to a gold, off the gold standard, the dollar became the dominant pair. And in fact, 7 of the top 30 largest companies in the world are banks, including JP Morgan, Visa, MasterCard, B of A, etc. Okay, well, in 2025, which is 2 generations later, it's not just the dollar that's becoming synthetic. Everything is going to become synthetic. Let me explain that. The first is the Genius Act, which is what Congress passed earlier this year, which creates the stage for a stablecoin boom. And then the SEC announced Project Crypto, which is encouraging Wall Street to move on to the blockchain. Remember, the blockchain is a public software, basically gigantic public software, but what it does is it verifies transactions and it stores records and information, and it eliminates a lot of the costs and friction that Wall Street experiences today. In fact, Treasury Secretary Bessent believes that just the stablecoin market could be $3.7 trillion compared to $250 billion today. That's exponential growth as we start to see Wall Street move things synthetically onto the blockchain. So what does that mean? Well, if everything's becoming digital, okay, you've heard a lot of people say, well, you want to find the digital store of value, the digital gold, which is Bitcoin. And that makes a lot of sense. That's what Fundstrat has been advocating for since 2017. That was more than 8 years ago. And in fact, Tireless Ken remembers when we first started writing about Bitcoin in 2017 and we said it would be institutionally adopted as digital gold, people ridiculed us. We lost a lot of customers actually because they thought we really lost our grounding to reality. But as you know, 8 years later, that's the narrative. Bitcoin is digital gold. Well, let's think about the next 10 to 15 years. Wall Street's going to build a market for digital assets. Now, for reasons I won't cover here, it's going to be on Ethereum because that's really where everyone is building this future. But the thing I want to highlight today is that Wall Street is going to build a market for digital assets onto the blockchain. So it's more than just dollars, it's everything. So think about this. There's two story arcs that are going to be the next 10 to 15 years why I think it's the biggest macro trade. The first is stable coins, the upward one. Stable coins, we're going to tokenize stocks. NASDAQ actually just approved that this week. We're going to tokenize credit, tokenize real estate. Maybe we'll monetize our reputations on the blockchain so we can value that. And we'll monetize intellectual property, which, as you know, is the largest component of CapEx today. So if you look at GDP data from BEA and you look at what they call private investment spending, the largest share of that is intellectual property. That is easily moved onto the blockchain. But then there's another story arc. If you're going to be able to digitize that information, you're going to monetize data collection, royalty streams, loyalty programs. As you know, that's a huge business, is the value of your frequent flyer miles. Then there's going to be agentic AI and things like proof of humanity. So that all is what you're going to see in the next 10 to 15 years. This is the biggest opportunity for Wall Street ever. Okay, so that gets me to the last point, and I believe there'll be time for questions too, which is I've given you 5 reasons to be bullish on stocks, but yet this is the most hated rally ever. And I believe I know the reason. I'm going to explain it, but don't get angry at me if that's the reason, okay? First, it is, in our view, the most hated V-shaped rally because at Fundstrat, we survey people, we ask them how they're positioned, what they think of multiples. This is not, we get cautious sentiment and skepticism. That's not what you expect at the top, and that's healthy. If people are skeptical at the top, that means there's still plenty of room for stocks to go up. And we can see it numerically. I like this survey. This is the AAII Bulls Less Bears. It's currently negative 10.7. That means there's more bearish people than bullish people. And in fact, for the last 5 weeks, as the market's made all-time highs, the net bulls is bearish. Do you see it? Minus 11. We've had 5 weeks while the market's made all-time highs and everyone's skeptical. In fact, this is from Tireless Ken, you looked at all the times the market had a 25% or more rally, and I put a red dot, usually sentiment's quite bullish by the time you had a 30% rally. We've had a 34% rally, and yet the average sentiment is still negative. That tells me, first of all, that most people went to cash in April. They didn't think we'd recover, and I don't blame you because I remembered at the April lows, we heard a lot of people tell us, Tom, there's no way we can recover because the Fed's not going to cut rates or expand the balance sheet, so you don't have any liquidity coming. Our argument was that waterfall declines always see reciprocal recoveries. Okay, but I believe the reason people are bearish is because of political affiliation. So please do not judge me. I'm registered independent, but I want to point out some facts. I am a registered independent, and I didn't vote for either candidate in this last election. But if you look at the general population, the US is 50-50 roughly between Democratic affiliated and Republican. Okay, so it should be half. But if you look at the University of Michigan survey respondents, and they published the affiliation, 60% of the people that respond to the UMich survey are Democrats. So when you see UMich inflation and confidence, just remember it's skewed because more people who respond are Democrats. The media, we know political affiliation is 89% Democratic. And we know that if you look at contributions by Federal Reserve employees, 92% donated to the Democratic Party. Okay, so as we run that down again, half the United States is Democratic, half is Republican. But media and the Federal Reserve skew Democratic. Well, look at the equity market. 57% of employees in the stock business are Democratic, 67% of hedge funds, and 69% of venture capital. Okay, So the equity world, or the risk-taking world, leans democratic, which is the opposite of who's in the White House today. Whereas the bond market, 83% of those who work at savings and loans are Republican. Mortgage bankers, 64%, and commercial banks, 60%. So the bond market leans Republican. That might explain something to me, because if you ask me in 2025, why did we not get bearish? It's because the high yield market barely reacted to the tariff headlines. Spreads didn't blow out. So we figured, well, if the bond market says the economy's fine, stocks should recover. So I think the reason why you might be bearish, or your friends might be bearish, is that the stock market is primarily Democratic and they think Trump is crazy, whereas the bond market leans Republican and think everything's fine. I believe this is the reason it's the most hated V-shaped rally. And so I got a few closing points. Well, first I just want to show you the survey. I mean, look at the UMich survey. The UMich survey, if you ask about inflation, Democrats respondents say inflation's 6%. 2 months ago, they said it was 9%. Republicans say it's 1%. So you can see there's a huge political divide. I mean, unless they shop at different stores. Okay, so this is how we want to be positioned. First, we like AI and crypto. So that means Mag 7, Bitcoin, and Ethereum. But we also like industrials, financials, and small caps because that's a play on the dovish Fed. And the last set of points here is more just a reminder. The first is you have to remember the rule of 10 best days. I know there's going to be a lot of folks here who are really good at market timing. I'm not one of those. Okay, but here's the thing. Since 1928, the S&P has returned 8% a year. That's the first row. But if you missed out the 10 best days in the S&P out of the 220 trading days, your return is negative 13%. Think about that. If you missed out just on the 10 best days in the S&P, in every year, you had negative 21%, negative 13%. Since 2015, that's still true. The S&P's returned 12% a year. But if you missed the 10 best days in the S&P in 2015, since 2015, every year, you had a negative 10% return. Let me just put this in numbers for you. In 2023, the S&P was up 24%. If you missed the 10 best days, your return was only 4% in 2023. In 2024, the S&P was up 23%. If you miss the 10 best days, your return is only 4%. So you get our point. You miss out on most of the gains if you sit out the 10 best days, which is why we don't want you to time the market. So that's it for now. Thank you, everyone.